Good morning or afternoon to everybody, depending on where you're at.
We're gonna get started here in a minute. Just let people log on and get their audio situated. Where's the little chat? Can someone speak up and say, ask, or can you see the screen?
Oh, yeah.
You have to unmute yourself. There's a.
Yeah, there's a yes.
Okay, yeah. Thanks, Chris.
This is our first time doing a webinar with WebEx, so you'll have to laugh quietly. You're free to do that, but bear with us.
So yeah, we're gonna leave things muted until we're gonna do a question and answer at the very end.
Oh, they can't unmute.
Should be able to. Okay, so it is 11:02. We're gonna get started. We have maybe 25-30 minute kind of presentation, and then we'll do a question and answer at the end. We're gonna stop promptly at noon Central Time to be respectful of everyone's time.
Should be able to unmute themselves.
So yes, this will be recorded and shared afterwards. So it's being recorded right now, and normally it takes a little time to process, but we'll send it out probably tomorrow. Okay, we're gonna get started. My name is Nick Drapinski. I'm the Workforce Housing Specialist with the department. I have with here Brad Weiss. He also works on the workforce programs with me. I kind of explained that I handle more of the front end application and of just general inquiries into the program. Brad handles the monitoring, compliance stuff, and then we meet in the middle. So we sit next to each other, so we talk every day. We work very closely together. So you can always reach out to either one of us or both of us. And yeah, let's get started. So the reason why we're having this, I'm sure some people were getting maybe a little nervous of like what's going on. So we have now that we have several program years and Brad had been monitoring, we were kind of finding that there was a lot of common issues that people were having. So, and also just through questions, we're getting a lot of the same ones. So we figured let's just do a webinar, get everyone together and just kind of go through some stuff. If something comes up and you're like, oh no, we are not doing that, don't worry. We're just here to help you get back on track. And so yeah, reach out and we'll go from there. So through the monitoring process, we found that most of the issues are simply because people forget the application guidelines or their contract or their investment plan. I understand that, you start the program, you get your money, and then you kind of forget about following the contract or, keeping up to date on that. So always be sure that you're referring back to the application guidelines for the general overview of the program. We do have policy memos out there for whenever we issue those. Those are on our website. A new one will be coming with the producer price index update probably in a couple weeks. Pay attention to the effective dates of those policy memos. And also obviously if there's an application, hopefully we'll have another one. Pay attention to those letters of intent, application deadlines, and then your investment plan. Your investment plan, those are the rules for your program. So if you're issuing loans, a potential applicant can come and they can read through your investment plan and understand what kind of program you're running and what their requirements are. And then keep your DED contract handy. Everything that you need to follow is in your contract. And if you have any questions on interpreting, different sections, please reach out. The same thing, I think people sign it and then they just kind of forget about it. And then be aware of deadlines. What deadlines? So we get a lot of questions about the 24-month deadlines. So there are 3 technically. So this, you have your contract period, which is 4 years, but there are deadlines within those 4 years. So the very first one is you have 24 months to engage in an eligible activity. So we define engage as you enter into contract. So if you are issuing a loan to somebody, you enter into a, if you're just talking, that's not starting an activity. As soon as you sign that contract, you have engaged in an eligible activity. From that point on, you have 24 additional months to allocate the remainder of your funding. So if you have a $500,000 award and you issue your loan for $250,000, now you have 24 months to allocate the remaining $250,000. So even though your contract is going to be extended beyond that time frame, you still need to have everything allocated within 24 months after your first eligible activity. Then the third 24-month timeline is for every project. So the second you sign a contract with a subrecipient and issue a loan, they have to produce units within 24 months or be reasonably ready for occupancy within 24 months. Why that's important is that sometimes you might sign a contract with a subrecipient and they're going to say that they're building 10 houses in a subdivision. If 10 houses are in the contract, that means that all 10 have to be ready in 24 months. If that's not possible and it's going to be 36 months, your contract should only be for the number of houses that they can complete in that 24-month time frame. So if they need to have multiple contracts, you can do that, or you should do that. And then infrastructure. Infrastructure is a hot topic. And remember, this is not an infrastructure program. Infrastructure is eligible, but it is a unit production program. So if you use your workforce money to put in streets, utilities, that's fine, but it doesn't mean that that has to be done in 24 months. You need to produce units within 24 months. Let's go ahead.
Okay, so kind of getting into the nuts and bolts of things. I realize that not everybody does loans. Some of you are doing work where you are acting as your own developer. So maybe you're issuing contracts with individual contractors and you're not necessarily giving out loans to developers. But what should all of that look like? Well, especially when I'm doing monitoring, I kind of look at it in 3 phases. First of all, what are your loan and contract documents? How are you securing your state funds, and what kind of agreements are you entering into? So just remember that anybody that you are paying with your ACT funds from the state needs to have some sort of an agreement from your agency. And so how are you doing that? We don't really define how you have to do that, but we do say that you need to do that. So what kind of documents do you have securing the loan? Are you using promissory notes? Do you have a contract? Is there a deed of trust? How are you doing that and making sure that information is available for us to look at? Also, how are you ensuring, one of the things that I want to mention is, how are you ensuring that those homes are being sold to homeowners? Again, we're not really telling you how you have to do that, but if you're building an owner-occupied home, how are you ensuring that when that home is sold, it's going to an actual homeowner and is not being bought by someone who's going to use it as an investment property? And then loan contracting and servicing documents. I put a little line in here that says this is probably the most overlooked part of the project. I know, having been in your shoes at times, that we are very much project people. We want to keep things going and moving along. So a loan or a contract is signed and we expect that everybody's doing what they're supposed to be doing and we move on to the next project. I would say this is where most of our findings, or a lot of our findings, come from, is not doing ongoing inspections, not making sure that contractors are doing what they're supposed to be doing and that things are moving along the way they're supposed to be moving along. And again, not an accusation, it's just that we're all moving along with our day and trying to get things done. And then also making sure that any changes or extensions of contracts are board approved and that information is also in your file so that we can verify that. And then loan and contract closing documents. somehow a final inspection needs to be done. Somewhere we need a closing date. So whether that's a final inspection that your agency provides, whether that's a certificate of occupancy, or if your city does a final inspection and signs off on a permit, whatever that looks like, we just need some verification that the project is completed and that it passed an inspection. And then information about the loan payoff, fee payments, interest payments, whatever your contract or your initial agreement states should be financially accounted for in your income and loss statement. And then reconveyances of deeds of trust, if that's applicable. Make sure you're getting photos along the way. I know that can be kind of a pain, but that's how we keep programs like this going, is that we advertise them and we let people know all the good work that you all are doing. So have somebody snap some photos along the way. And then listing or sale dates, cost to construct information, and then listing or sale prices. Know by which standards your project will be monitored. Some of them are by cost to construct, some of them are by sales price. But most of that information, I'm assuming you're gathering along the way anyway. So if you have that, it's just good information for us to have to keep statistics for the program, but then you're covered on all sides when monitoring time comes along. And then project-specific information. Just remember that you have to follow your investment plan. If you say you're going to do something in that investment plan, then that's what you need to do, and that's what we'll be monitoring on. Qualified activities, just remember, need to be used in conjunction with eligible activities. So if you're going to do DPA, it needs to be in conjunction with a rural workforce eligible project. Developer and contractor applications and scoring need to match your investment plan. However, you said you're going to take applications and how you're going to score them, that information needs to be included in your files so that we can verify that. And then making sure that all of your projects and contracts have been approved by your governing board or committee. And making sure that your developer and contractor provides you with proof of state and federal registrations. We'll be talking about that a little more in depth in just a few seconds. Agreements and contracts for any developer receiving rural workforce housing funds should include these things. We need the project information. What is this contract funding and where is it going to be built? What's it going to be? What's the amount of the loan or fee to be paid? What are the terms of the loan or payment that you're giving out? How will it be paid? One lump sum or installments? And we've had both along the way. Agencies are doing both things. It seems like more people are going to installments. So how is that going to be done? Are there timelines and benchmarks for those payments? Did you communicate the guidelines that have to be followed per your investment plan and rural workforce housing fund? Did you communicate those guidelines so that the contractor or developer knows what you're expecting? And then one of the things that we've come across, we've had folks that have had things happen with developers or contractors that they were not aware of, that put them outside of the guidelines. And so one of the best practices that we continue to communicate is that you have some sort of consequence for going outside of the investment plan. If they're not doing what they're supposed to be doing, what's going to happen and how are you going to enforce those procedures? We've been seeing more and more people adding that. But again, we need to make sure we're communicating those guidelines so they know what's expected. And then in that agreement, are you including from your contract? And again, we're going to talk about these a little more in depth here in just a few minutes, but the conflict of interest clause, the contractor registration clause, and the work eligibility. And then making sure, again, any extensions include board or committee approval.
Really quick, just on that note with the conflict of interest, it is real or perceived conflict of interest. If you think that you might have a conflict of interest, reach out and we will talk through that. Before you start this, Nick, we do have just a quick question.
If you do not have a monitoring checklist, if you've never received that from me, please reach out to me via email and I will send that to you. Make sure you have that so you know how your project, what I'm going to be looking for in the monitoring.
So we've had a lot of questions about down payment assistance, so I just wanted to briefly talk about that. Down payment assistance is an eligible qualified activity, but it has to be used in conjunction with a construction project. So if the house was built or rehabbed using rural workforce money, you can use down payment assistance on that unit. You cannot run just a DPA program for any house in the community. Once again, this is a unit production program, and just DPA for any house in the community is not adding units. So it is eligible on houses that were built or rehabbed using rural workforce. We have questions about limits or setting that DPA amount, and just kind of a little explanation. So the affordability gap, we use that term to describe that amount of, there's a sale price and then what a home buyer can afford or what they can qualify for a mortgage. If you want to do a percentage of that for down payment assistance or all of it, depending on, just the individual property, that is, a good way to, get people into that house. The appraisal gap is the gap between the construction cost and what it appraises for. So if it costs you $325,000, but it's only appraising for $300,000, that $25,000 is the appraisal gap. This is not down payment assistance. It's not, it's just, it gets eaten up by your program. And then how do you cover down payment assistance? Forgiveness is eligible, but I would highly, highly encourage everyone, if you want to have forgiveness, do it over a long period of time. We want people to stay in the community, then stay in their house. And we've actually seen some houses that they sell and then they're sold again 2 years later. So if you, and also if this is a revolving loan fund, you want to get that money back. So one of the more popular terms for down payment assistance is that those funds are due upon resale. So if that homeowner ever sells their house, that money comes back to your organization. Obviously, there's legal mechanisms that you have to include in that as a lien, but then that way that money is coming back, and it is not just unreal or realized equity that they did not contribute themselves, or the homeowner does not contribute. Cost limit compliance. So one of the big statutory regulations is cost to construct. So the cost to construct for owner occupied rehab is, or sorry, for owner occupied housing is $325,000, and for rental units it's $250,000 per unit. So for rentals, you take the total development cost, divide by number of units. That number can't exceed $250,000. We've seen a few times now where those limits are exceeded, and that is a direct violation of the statute. So we highly encourage, if it's not addressed at least a little bit in your investment plan or your loan documents, mostly it could be in your loan documents with your contractor, you need to make sure that there is some sort of a penalty. And that penalty has to be enough that it stings a little bit. So if that penalty is, if you go over the limit, you get $1,000 penalty. Well, if the contractor ended up, profiting 15,000 or 20, how much ever, then it's still, it's still profitable for them to continue making violations. So a lot of times, one popular thing is like they institute a different interest rate. So let's say their original loan agreement was for 1% interest. If they go over that cost to construct, then they owe back plus 8% or 10% interest. I don't know the magic number for you. This is something that you should discuss with your board and your staff. But as long as there's some sort of a penalty, that is the important part. But obviously, we would just prefer if there was no overages on that limit. We'll get to the chat questions here in a minute, but for Q&A.
Okay, now a few slides of all the exciting stuff. So shake your head and wake up for just a second here, and I'll try to make this at least somewhat brief. Compliance documentation, and all of this is from your contract. I know that contracts can be a little bit of a boring read, but there is a lot of stuff in there, and contractual violations are probably also one of the most common findings that we have. So I just want to bring a few things to your attention. The 2022 and 2024 contracts are a little bit different, so I'm going to be referencing both of them because I know we have people from both rounds on the call here. So 2022, the contract states, and just a reminder that all the provisions of your contract and the requirements of the program are binding to any of your subrecipients or contractors. So you need to be making sure that you're communicating those things to your contractors. Again, read and review your contract if you've not done so. If it's been a while, get yourself a little bit of coffee and sit down and read it. It really doesn't take that long. I read and reread them on a regular basis, so it could be a lot worse. Remember that all the monitoring standards are devised from the Rural Workforce Housing Guidelines, your investment plan, what you tell us you're going to do, and then your contract with DED, and then any new policy memos or statutes. So you need to be following those things. And then again, I mentioned earlier that the 2024 contract verbiage is a little different and it's a little more defined. And if anybody from 2022 would like to see a little bit of that, I think we can probably provide that. It's basically the same, but a little more defined, and I'll be covering both here. Subcontractors and recipients. Now this comes from the 2024 contract, section 204, and it's 411 in the 2022 contract. And basically it just says that you might be using other organizations or agencies or entities to carry out your eligible activities. And you need to make reasonable assurances that that subrecipient is going to comply with the requirements of the Rural Workforce Housing Program. So we talked about that. In fact, we've mentioned it a couple of times. It's your responsibility to make sure that they know what those are. I've seen recipients share the contract with contractors. I've seen them spell it out different ways. So how are you gonna communicate that? You need to be able to demonstrate that your subrecipients have sufficient experience and the ability and financial capability to undertake and comply with the Rural Workforce Housing Fund. And then that your subrecipient has demonstrated familiarity with the requirements of other federal, state, and local housing programs. Basically, it's just saying that you can be reasonably assured that they know how to carry out the program and follow the guidelines. Registration requirements. Again, this is from the 2024 contract. It's also in the 2022 contract, but doesn't spell it out quite this succinctly. But what this is saying is that anyone that you use, anybody that you enter into a contract to utilize rural workforce housing funds, needs to be properly registered with the state. If they are a development agency, maybe they're an LLC or a corporation, they need to be registered with the Secretary of State, however they are, their company is filed. If they are a sole proprietor, you need to have some sort of proof that they're a sole proprietor, whether you have a piece of paper that they sign stating that, or oftentimes I'll even get a piece of paper from the Secretary of State just stating they're a sole proprietor. And then the Nebraska Department of Labor, if they're physically doing construction work, they need to be a licensed contractor with the Nebraska Department of Labor. I will tell you that the only time I've ever been checked, I was in West Point, Nebraska, and when I was with my last nonprofit, and the Department of Labor was going around doing checks on construction contractors, and I had to produce my license. So they do check that, but the state requires that all contractors are licensed. You need to be able to verify to the department at monitoring that you have checked that, and the easiest way to do that means that you have gotten a copy of their contractor registration or their or their registration with the Nebraska Secretary of State. Conflicts of interest, another area that we have had some monitoring issues in. And so I'm going to give you just a very brief overview here. My recommendation would be that you also add this information when you're talking to your contractors so that they're aware of what a conflict of interest entails and what your expectations are of them. So the general verbiage states that no officer, employee, or agent of the recipient will participate in the selection or award or administration of a contract supported by ACT funds if a conflict of interest, real or perceived, would be involved. And then says in your contract that this stipulation must be included in all other contracts and subcontracts related to projects financed with ACT funds. So you have to make sure this is communicated to your subrecipients. An agent of the recipient is anyone who's utilizing rural workforce housing funds, or they're integrally involved in the planning, administration, or completion of a rural workforce housing contract. So basically anyone on your board, anyone on staff, anyone that you are loaning money to or paying money to carry out a contract is an agent of your organization. Board and staff members with conflicts are unable to take part in rural workforce housing fund discussions. So if you have someone on your board that's a developer and they are applying for rural workforce housing funds, they must recuse themselves from all discussions about rural workforce housing, not just the voting, because their opinions are gonna weigh in on those discussions. Units must be sold or rented on the open market or by the terms of an approved investment plan for income-based programs. So that just means that the units are being made to be sold publicly and they need to be advertised and sold publicly. Or if you have such as a Habitat for Humanity or some sort of an agency that does those sorts of programs, they just need to be placed in a competitive program just like anything else. If you have any questions about that kind of stuff, please always feel free to reach out to us. One of the problems we've had is that contractors, developers, recipient agents, and employees are not eligible to buy owner-occupied homes if they have been given a loan and they're being paid to build it. They are an agent of your agency and they are ineligible to purchase it. We've seen contractors who have bought homes in the past and that's not eligible. If someone else builds it and it's sold on the open market and they didn't have their hand in it at all, those things may be a different story. But if they're involved in a contract, they are ineligible. Units cannot be specified for employee or short-term housing. We've had questions from colleges about building dorms. We've had questions from companies about building employee housing. And that is ineligible. The purpose is to get units on the market to be sold or rented. Please reach out with any questions again before they become an issue. We really are here to help. We're really here to make your program successful, and we want to do that as much as we can. So please make sure you contact us. I put this line in here because you are more than welcome to copy and paste the contract verbiage into your contracts. But you might want to clarify some of these things because the contract doesn't state a lot of these issues. Your contract with DED does not state a lot of these issues. So you may want to make contractors aware of some of these things. Verification of work eligibility, we're all aware of this. You must agree, it's in your contract, to verify all new employees physically performing services within the United States, and then it is your contractual obligation with the state to make sure that you are verifying that all of your subcontractors are also verifying their employees. Now, that's not saying you have to verify their employees, but you need to, in some way, just like we're communicating it to you, you need to communicate to them that they need to be using some sort of an e-verify system, and you are responsible for enforcing that with your subcontractors. And then again, your contract states that a failure to do so will be deemed a substantial breach of the contract.
Okay, just a couple more. Financial management. Most people, I don't think, have an issue with this, but we just kind of want to reiterate that your ACT funds, your rural workforce housing funds, must be kept in its own designated account per award. So don't mix it with general funds. If you have a 2024 and a 2022, don't mix those together. They have to be in a separate account per award. You can keep your matching funds in there and just account for them separately, but we should always be able to see what the ACT funds are, what the match funds are, interest earned on ACT funds and interest earned on matching funds. Any interest earned on ACT funds become ACT funds. And that's important because ACT funds cannot be used for administration. You can use your matching funds and interest earned on matching funds, but you cannot use ACT funds. If you have specific questions about what are administrative expenses, please reach out. It's normally, staff time, reporting, stuff that's, just generally goes to managing the grant. And ACT funds are for your construction cost, actually getting the units built. I think that was, I covered all that. And then reporting requirements, people generally do a good job with all of this, or as far as annual reports go. So those are due February 15th. You'll get an email from me after the first of the year about, annual reports being ready. That's just what did your previous calendar year look like? How many units did you build? DOD in progress? It just, we're just monitoring the project. And it goes for every year that you have ACT funds within your contract. So if your contract ends in, let's just say, June of 2026, you still have to report on 2026 in 2027 because you had 6 months of 2026. So you're always going to have one more after your contract ends. The annual review, I know this is a pain point for most people, but an annual review by a CPA is required for every year of the contract. I know these come in, periodically. It depends, when your fiscal year ends. But as soon as you have an annual review completed, please send it to me. We're working on building that out so you can just enter it into Amplifund. But we definitely need those, and you can pay for those expenses with your matching funds. So we hear, oh, it's really expensive. Your matching funds are there for admin. This is a perfect example, or a perfect, where to use your matching funds to pay for those annual reviews. Technically, they're not due for, it says in your contract that they're due February 15th, just February 15th. Technically, they're due like the following year. So if your fiscal year ends December 2025, technically it's not due February 15, 2026, it's due February 15, 2027. And that just gives you obviously time for the CPA to do their work. If you have questions about annual reviews, I think they're probably very specific. So please reach out and we can have those conversations. And that was all we had. We're only 2-3 minutes over. We started a couple minutes late. Let's see, we had a few things in the chat. I know everyone can see this, but can you scroll up a little bit? Lynn actually responded to one. Yep. Scroll up a little bit more. So we had a question: with the proposed 2026 mid-biennium budget request shifting all remaining and future funds from rural workforce and middle income to the Affordable Housing Trust Fund by 2027, how will this affect monitoring, draws, etc.? All of the rural workforce, all the money's out. So of course we'll have to see what happens next year with the statute. And my boss Lynn responded, our housing director said, at this time the department does not anticipate this mid-biennium budget request to have any impact on, scroll down all that, any impact on monitoring or draws. So no issues yet.
I apologize. The program keeps telling me that you can all unmute yourselves, and it's not allowing me to unmute you. So I'm not sure if you're not able to unmute yourself. I'm trying to figure it out.
Put it in the chat and maybe unmute. What does that do? Nothing. Let's see.
No sense here.
We have another question. I'm guessing that the CPA's review of the rural workforce dollars and contracts can be pulled from the organization's overall annual review or audit. Yes. So if your organization is getting an annual review or audit, of course they would look at your rural workforce program. So yes, that it's for your organization, not like specifically your rural workforce account. And then can we get a copy of the PowerPoint? Yes, we'll send that out. We'll probably just do that with the recording. And then Can you go over the comments you made about interest earned off the contract funds being treated as ACT funds and not eligible for being used as admin expenses? So this is something that has been kind of cleared up. So it was not always maybe the most obvious. If you think of the ACT funds sitting in the state treasury, they are generating interest. So then as interest is earned on that, they become ACT funds sitting in the treasury. It's the same way if they're sitting in your bank account. So that money is earning interest because it's in there, it's ACT funds. So any interest earned on the ACT fund portion become ACT funds. So you really should be, that comes back to the, accounting for separately, your ACT funds and your matching funds. Any interest earned on your matching funds, of course, becomes matching funds. I know a lot of matching funds. I mean, it's kind of tough because it's not always like 50-50, but if you get an interest payment, at the end of the month, you should figure out how much of that is now accounted for under ACT funds and how much of it is accounted for under matching funds. We keep our matching and ACT funds in one account per award. This makes it difficult for interest tracking purposes. You mentioned, how are other communities tracking this so they don't have so many different accounts, which gets hairy when you have a larger loan that pulls from multiple accounts for tracking. I can't really speak to like what other yeah, thanks, Sherry. You said, yeah, set up a spread. A lot of times we just see like, they have their QuickBooks, so they have their Excel documents, and then there's just like some formulas that they use. I know it can get tricky if you have multiple awards, but then by that, like let's say you do have 2 awards and you're loaning 60% from one award and 40% from another award on one project, then you just need to keep that ratio for your interest, your payments back to the fund. I think this is maybe a little deeper conversation, Amanda, if you want to.
And it is okay to do it on an Excel spreadsheet. I know I hate to speak for Sherry. I hate to not be able to unmute you all. I apologize again, but Sherry does have a wonderful way of keeping track of multiples. And so I would encourage you, I'm sure she would be more than happy to share with you how she does it. From SCED, Sherry's from SCED, I'm sure you know that, but South Central Economic Development. Again, I apologize for not being able to unmute, but if anybody else has any questions, please put them in the chat.
Does the awarded organization need to complete the annual review before receiving any rural workforce funds? No. So this was a issue in the past. I think it was even for the 2022s that it was required that you have to have an annual review prior to submitting a payment request. Our lawyers kind of clarified that we interpret the statute to mean that an annual review is only needed after you have those ACT funds in your account. The annual review, that's kind of the whole point, is to make sure you're to look at your ACT funds. Well, they can't look at your ACT funds if you don't have them in your account. So you will have it the following year after you receive your funding, your disbursement.
As far as your annual review or annual audit, yes, it needs to be your accountant's audit of your entire entity. You bet. Short-term housing, what I'm talking about more is kind of like we were talking, we've had some questions about whether or not rural workforce housing funds could be utilized for renovating a college dorm to be used as college rooms. And we've had questions about whether or not it could be used, say, a hospital with traveling nurses that would just come in and stay for a while and then be gone. And those are not are not eligible under this program. Again, the idea of the rural workforce housing program is to produce units for permanent units for renters or owner occupied units for home buyers.
I know that's
Yeah.
a struggle in different parts of the state, but yeah, this program just statutorily does not allow it.
Yeah, we don't really make a determination. I'm not checking to see how long leases are on the properties. I don't think we have any regulations that I'm aware of against a 6-month lease. The point is that they are homes that are being utilized for, for individuals for more permanent housing. If specifically that those 6-month leases are being done, I guess it's more of a, thinking through what the purpose of the program is. If someone is specifically using a 6-month lease for traveling nurses or something like that, then it would be ineligible. If it's a 6-month lease, but the project is for permanent homeowners, and someone gets in there and leaves in 6 months, that's out of everybody's control. So I guess it's a more of a point of the program answer, if that makes sense.
Edward had a follow-up question about the potential transfer of rural and middle income into the Affordable Housing Trust Fund. Right now, like we don't know what the legislature is going to do, so we can only go by what we know now. And there is no money in the rural workforce or middle income account like we just had awards. So we're just gonna have to keep an eye on the legislature and see what happens. But all very valid points, Edward. Can a resident in the community utilize the funds for construction if they will also be the person to live in the rural workforce funded house? I believe this would be a conflict of interest.
My initial reaction is that, yeah, they're applying for it, and then it would be a conflict of interest. It would be not a lot different than a contractor borrowing, the money at a 1 or a 0% interest and then building a home and deciding to buy it for themselves. There needs to be a competitive process to distribute the units.
I remember back in my CDBG days when you're doing owner-occupied rehab, that question had come up of, if the homeowner is an electrician, can they do their own work and then, get supply or get materials paid for? And the answer was always no, because that is a conflict of interest. So if you would like to discuss that further, Bobby, please reach out and we can have a little chat.
You bet. We still got plenty of time. I know everybody is busy, so.
Can you address the cost cap versus no sale price maximum, if that makes sense? Example, someone builds at a cost of $320. Oops, I lost it.
Oh, it's right there.
There we go. If someone builds at a cost of $320 and to cover closing costs needs to list higher than $325, what is DED's feeling on that? So we go by cost to construct. So if there are closing fees and that's kind of part of the sale, it didn't affect the cost to construct. This is not everybody, but a lot of people have sales price maximums in their investment plan. So if they're in there, they used to be sales price, like that's how we ran the program. But there was a change. They just went to cost to construct. But there are recipients that have like their target sales price, like they want to keep housing at this price point. So if it's in your investment plan, that's what we look at monitoring. So if it exceeded what you said you wanted, then that would be an issue.
There's a question: is there an appropriate degree of separation to avoid a conflict of interest? For example, a related individual to the organization buys the house but moves 2 years later, can someone with an association to the organization be a buyer at that time? We're looking at the initial sale of the home, that a unit was produced that meets the guidelines of the program, and then after that sale, it's not something that we are monitoring. So it's that first sale, getting it on the market within the guidelines is what's important. Yes, all the slides will be available. The recording of the video will be available. We'll have it all for you.
So if it costs $325,000 to construct and the house sells for $350,000, is that allowable? We just look at cost to construct. That's the statute. If it sells for $350,000, I mean, we would document it, but I mean, it is allowable. I would really caution you if you're looking at housing that is going to sell for that. I know markets are different across the state, but we've had numerous instances where they build a house and they list it for $325,000, $330,000, and they just can't sell it. The local market just cannot support that. So, but that's up to you. The fit to your community.
Suggestions on how to substantiate document cost to construct. We have folks that literally give me a spreadsheet with itemized construction costs. That's always interesting to take a look at, and it certainly substantiates. And then I have folks who will give me, I will tell you, I would prefer not to just have a written letter that just says it cost me $325,000 to build this house. To me or anyone else that comes in to check my work, that could look a little suspicious. I would prefer, it doesn't have to be broken out nail for nail. It would be nice to have some idea of the major construction milestones. Concrete costs this much, framing costs this much, roofing costs this much. As detailed as you can make it. You certainly don't have to give me a nail by nail. I think one of the things that we need to know, obviously the cost to construct doesn't include acquisition or land. Just for our own knowledge, because we get questions on this all the time about infrastructure and about land. If you have those costs, again, I just want to verify that this isn't a situation where, we're taking information and trying to figure out how to nail people. We want you to be successful. So the more information you can give us, the more information we have to communicate to you all when you have questions. It's interesting to know what land costs are across the state. It's interesting to know what infrastructure is costing across the state, because we get those questions. So if you can give me a cost to construct, this is what it cost me to build the house. That's what I'm going to use. This is what we paid for the land. That way I know this didn't include the land and this is what we paid for infrastructure, acquisition, if it's a rehab. It's just interesting to have that information. Like I said, not a nail by nail accounting, but the more detailed you can be, the better. And then just somebody signing it. This is what it cost, and I'm verifying that this is true, whether it's the contractor or someone from your agency.
So is there any discussion that you've heard of legislative to change or take out the perceived wording that relates to conflict of interest? This is an issue in smaller communities. I have not heard any proposal or issue, someone bringing that to a senator to introduce. We are aware that is an issue. There's lots of communities where, you have to have a developer or a contractor on your board because you're a housing organization, and then they can't access your organization's fund. There's no way around it. They can't, they either have to step off the board or then you lose a board member. So I understand the pain, but we can't do anything about it. So we have to follow the rules. Are you getting any feedback that 325 is too low? I have contractors in Greater Nebraska saying they can't stay below the 325. Yes. we hear that, yeah, 325 is way too low. But then we have other people that are like, well, we're building for 250 to 265. So it varies so much across the state that it's just more expensive to build in different areas. But it's that 325, that cost to construct 325 is by statute. So it is, we don't have any authority to say like, just don't worry about it. It is statutory and it's a hard and fast limit. Thank you, Sharon. I was going to bring this up. So can you explain why we're being told only grant funds from 2024 are eligible to be mixed with NHTF? So back in 2023, there was a change to the statute, the rural worker statute, that it used to be that you couldn't use any other state or federal funding. And there's a change to it that allowed layering to be with Nebraska Affordable Housing Trust Fund, or NHTF, as long as it did not limit incomes below 100% AMI. So if you have rural workforce and NHTF, you cannot go below that 100% AMI, and then NHTF is 120% AMI. So you have to get in that little window. Back when that changed, we were a little unsure how this all worked, but when a statute is passed or a statutory change is passed, it is not retroactive unless the statute explicitly says that. So we've had some conversations with our attorneys, and I've read a lot of bills and statutes, but not all of them. And when there is a change that they intend for it to be retroactive, it needs to state that in the law. So that using that, now that 2022, they would not be eligible. The 2022 awards are not eligible. And since it happened in 2023, then it's okay for the 2024 awards, but it wasn't retroactive. So I learned something, to be honest. But again, that's if you're working with a senator on sponsoring a bill, it needs to state that it applies retroactively to all open contracts.
Bobby, does the slide answer your question, or is there anything specifically that you were looking for?
I guess it's specifically it's a 24-month. Bobby, yes, it's from the it is not from your notice of award. It is from the time that it hit your bank account. So they were dispersed into your account. What if a person that has a conflict by being on the board not only abstains but does not attend the meeting it is being voted on? Would that avoid the conflict of interest issue? So if there is a conflict of interest, it states in your contract that you have to release that or tell the department. So send me an email. And then, yeah, that person, it's not just when they're talking about like their project, it's anytime, you know, it goes to, okay, let's talk about rural workforce. They cannot be a part of that discussion.
Yeah, Bobby, it's from the time that you get so when I'm doing monitoring, that's part of the reason, one of the reasons I need a profit and loss statement for that checking account is that I look when the the ACT funds hit your account. So from the day that they hit your account, then I count 24 months. And within that 24 months, you need to have initiated an eligible activity.
Time of disbursement and funds from previous rural workforce that have been closed be mixed with NHDF. So for those who maybe don't know, so there was a 2017 program year, so it actually happened in 2018. That was the first rural workforce year. Then there was another one in 2020, 2022, and 2024. The 2017s and 2020s are out of contract. Those expired. Once the contract expires, it is up to you and your organization to continue the investment plan, but we only monitor and we only look at what happens in the contract period.
We've got a few more minutes if anybody else has anything. Thank you.
Thank you, Jeff.
I do want to say that over my time monitoring, I've seen many different things, and I do have some wonderful people out there in Nebraska who are more than willing to share. I have a few folks who really have done their contracts very well to protect the money, to make sure projects are moving along, that have given me permission to share, and they would be happy to speak with you. Folks that are doing a really great job of accounting. And so if you need to be connected with anybody, we're here for so many things, and often we're underutilized. So please feel free to contact us, because it's much easier on us and much easier at monitoring time if your project is successful and things are going well. So please make sure you contact us. We're more than happy to connect you with the right person if we can't answer the question.
Do you monitor rents at all, or only the cost to construct each multifamily unit? We only go by the cost to construct. We note the rents, but that is not by statute, so we only look at the cost to construct. That said, this is just kind of maybe a little editorializing, because we've seen projects that get built and then no one can still afford it. With the workforce program, obviously, lower interest rates, some benefits to, any sort of forgiveness or whatnot. It's supposed to help keep costs lower. And ideally, those savings should be passed on to the end user. So the owner or the home buyer or the tenant. It is not to increase the profit margin. So of course, we want to take care of our developers and contractors. Work is not free, but we do look at like the rents, just kind of more of an interest thing, but by statute, it is not a requirement. I read a thing the other day. I don't know if you get the Harvard housing newsletters. I like those. And there was an article the other day that said that even if interest rates for mortgages went down to 0%, it would not. It would still be more expensive than 2020 levels. So bottom line, no matter how low interest rates go on mortgages, housing is just too expensive to construct, and people should be building smaller, more entry-level housing. So easier said than done, but interesting point.
All right, last call. Any other
3 minutes.
questions? And again, feel free to email or get in contact with us anytime. There will be other questions that'll come up, I'm sure. Before we do another one, I will get this muting and unmuting thing figured out. It'd be great to hear your voice.
We practiced everything.
Yeah.
Not that.
We're glad it was helpful. Thank you all for your encouragement.
And thank you all for your work. Obviously, like we're on the side of administration, so like we always like getting out, the ribbon cuttings, because yeah, you guys are doing great work, and we couldn't do it without you, and we're happy to be partners with you all.
All right. Well, with that being said, I think we'll call it a day. And again, contact us if you have any questions, and hopefully we'll see your faces sometime soon.
Sorry, I just thought of this. So we'll send out the recording and the slides once the recording's available. Along with that, there's been just some staff changes or whatever. So if you do have staff changes, and please make sure you're updating the grantee information under the custom tab in Amplifund. I do have to unlock it when that happens, but so just like let me know and I can unlock it. You can change your grantee information. And make sure you have a grant manager listed in Amplifund. I will include some instructions on that with that email.
All right, with that, we'll call it a day. Thank you all for giving your time. Appreciate it.